9 Bad Investment Habits. Bad investment habits are just like real-life bad habits. You keep doing them, and they keep hurting you in the long term. Just like smoking or drinking too much, bad investment habits hurt your wallet. But unlike those two, instead of damaging your health, they damage your future wealth, your retirement plan, and your life goals. And as if there couldn't be anything worse than all of that, most of them are caused by our standard behavior and biases. Welcome to the 9 to 5 Rebel, and in today's video, we dive into 9 most common bad investment habits people tend to do. Don't forget to subscribe to our channel and to turn notifications on for more great videos like this one. Without further ado, let's begin. Active trading. Active trading consists of buying and selling securities for quick profit based on a short-term movement in price. You hold a position for only a short amount of time and then sell it for a profit. Of course, the first example that comes to mind is day trading, which also tends to employ 5 or 15-minute charts. Active trading is very closely related with overconfidence, an emotion that's actually extremely common among investors. Overconfidence is such a recurring pattern of behavior that Ponzi schemes and scammers thrive on people's overconfidence to make them believe they're able to do whatever they tell them they can do. In other words, they stroke their egos, and they swindle them from their hard-earned money. As a matter of fact, most active traders are underperformers in the market because of how high it correlates with overconfidence. Trading excessively boosts your ego because you feel like you're doing something and earning money from it. However, it's much better to use traditional brokers and remain in touch with them than trading online and driving your investment fund to the ground. So don't fall for the active trading trap. Instead, use a traditional broker. Disposition Effect. Next, we have the Disposition Effect. This is a behavioral pattern where investors sell winning positions and also hold on to losing positions, one of the most counterproductive investment strategies. Even defining it sounds like something iffy is going on with it, and many studies report that these investors are also underperformers. That's because these loss-averse investors sell their high-performing investments to recoup their losses on poor performers, which ends up doing the exact opposite. That's why loss aversion is such a terrible bias. You think you're avoiding to lose, but you're actually ensuring yourself a loss in the long term. Focusing only in the short term will net you a very small, short-lived profit that won't last anything anyway, so why do it? Instead, focus on playing the long game. Paying more attention to the past returns of mutual funds than to fees. Paying more attention to the past returns of mutual funds than to fees sounds like a mouthful in all honesty, but it's yet another investment killer that's probably the reason why your investments aren't working out. Investor fees are seen as insignificant, and newbie investors disregard these as dangerous. In fact, these fees are unjustified, as they are usually charged by portfolio managers who don't really have any particular skill that the investor himself couldn't develop. If you disregard all these small fees that come with the trade, then you'll end up with less money than you projected. Most investors with high financial literacy tend to pay low fees, precisely because they know that fees are more akin to leeches than actual services. Instead of blood, they're leeching your hard-earned cash.
Really important, and people looking at fees say, no, they can't be. And I say, yes, they are. And people say, they can't be. And then they think of a 4-letter word and a single number. The single number is 1%. The 4-letter word is only 1%. And that is not an accurate way of describing fees. First, you ought to say, first of all, you've got the money. So you already have your money. So it's not 1% of your money, it's 1% of something else. Your manager, okay, is going to deliver investment results. Fine. What investment results is a normal expectation? 7, 8%, maybe? Okay, let's say 7%. What is the fee of 1% of assets? What's that same amount as a percent of returns? About 15%. 15% is a lot different from 1%. You don't use the word only with 15%. There is no better way to identify which funds will have the best future returns than low cost. And low fees is over and over and over again the best predictor of better results. Even the head of Morningstar has explained that they've done the research and come up with the best predictor of future performance is low fees.
Familiarity Bias. The next bias we're taking a look at is the Familiarity Bias, which is actually one of the most common behavioral patterns of all. That's because we humans seek familiarity as a natural behavior. We feel more comfortable with things we know about or that we can easily assimilate as similar to what we know. People would rather invest in things in their own country, region, state, or company. The big meaner brother to the familiarity bias is employees' preference for investing in their employer's stock. That's a violation of the principle of portfolio diversification, as concentrating in one asset will drive the share's value to the ground if the company performs poorly. While it's understandable that you'd invest in things that you know about, diversifying is actually much safer than putting all your eggs in one basket. Manias and panics. Everyone knows about this one. Come on, even the most cool-headed investors have felt cold sweat when things aren't going right. Financial mania can be loosely defined as the rapid rise in the price of an asset, causing a high degree of enthusiasm on investors' side. Of course, they are reaping what they sowed, so why wouldn't they feel elated? However, every inflated bubble must eventually burst, and when it does, and the price of the asset plunges, most investors would panic. I've found that the most euphoric you feel when an asset's value is rising, the more depressed you'll feel when it plummets. However, diversifying your portfolio, especially including fixed income securities, will save you from this. Even if one of your assets' prices plummets, you'll still have others that might even be doing better, and thus mitigated the impact. It's also nice for your mental health, which is an added bonus. Momentum investing. Now we have momentum investing, a strategy so riddled with fallacies that it's surprising people are still falling for it up to this day. Momentum investing consists basically in an investor buying securities with high recent returns and selling those with low recent returns, expecting past trends to continue. While this could happen in a few cases, it's more wishful thinking and herd behavior than anything logical. You're not analyzing why a security might have a high return, you're just watching the news and following the trends you read online to base yourself on what other crowds are doing. Don't follow these trends, and don't follow a variable that doesn't really correlate with what you're attempting to predict. Naive diversification. So, we've heard that diversification is good. However, while diversification can mitigate the effects of varying prices, you need to diversify smartly, and not just buy a bunch of additional baskets and throw the eggs in it in an attempt to feel safe. Some investors contribute to retirement plans without any kind of strategy, just to feel like they're, not following the trends or not acting dumb. Retirement plans should be designed carefully to make sure that your diversification strategy actually works for your case. Seeking a financial advisor can be the best solution to this case, as they can properly guide you through all the steps based on your personal circumstances. But once again, be mindful of those fees. Noise trading. In an era filled with fake news, hoaxes, and frankly a bunch of nonsense in digital media, it's easy to fall for just any trend or breaking news that we find in economic magazines and blogs. Noise trading involves making decisions based on false signals and short-term volatility. The result is poor timing, overreacting to good and bad news, and buying attention-grabbing stocks that you saw in the news and ended up being worthless. The best way to avoid this habit is to simply stick to proven sources of information and not panic when you see your fellow investors tweet about X's stock prices suddenly rising. Under-diversification. And finally, we have under-diversification. Under-diversification is pretty self-explanatory. It's another form of the inadequate portfolio diversification disease, similar to naive diversification, but it means that you're diversifying very little, instead of without any strategy. Portfolio theory recommends that portfolios should hold at the very least 300 stocks, though the average investor actually holds 3 or 4. If you have a very low number of stocks in your diversified portfolio, consider expanding faster than I could say stock. And those are the 9 mistakes and their solutions. I also want to clear up that if you make any of these mistakes or follow these bad habits, that doesn't mean that you're a bad investor. We all make mistakes after all, and as I explained in the beginning, only by understanding them can we work to find solutions and avoid them in the future. By transforming these bad habits into their solution, it's easier to deal with investing anxiety, self-doubt, and internal conflict when push comes to shove. With time, your investments will not only become more rational, but you'll start seeing less losses and more wins, instead of just avoiding losses. You can start off with your first win by taking advantage of an amazing deal on the link in the description with Robinhood and webull, pioneers of the commission-free investing, giving you more ways to make your money work harder. So what do you think of these very common bad investment habits that hurt your net worth? Do you agree or disagree with them? If so, which ones? Let us know in the comments below. Also, make sure to leave us a like, share this video with your friends, and subscribe to our channel for more videos like this one. We hope you enjoyed it, and we'll see you next time.